All right, good afternoon, everyone. Welcome to our free webinar on Startup Accounting Essentials. My name is Jason Kennedy. I am your host and moderator for the day today. Our presenter for the day is Alaa Ismail, Consulting CFO for Early Growth Financial Services, based out in the Bay Area. This is going to be approximately an hour long. We will go through the presentation. You'll have the opportunity to ask questions throughout the presentation today. You can use the questions panel that's within your GoToWebinar console. So you can ask questions through there. We will do our best to answer these questions as quickly and as many as possible throughout the presentation. We will have a short Q&A period at the end of the presentation. Any questions we don't get to, we will of course follow up with you as soon as possible once the webinar is concluded. This webinar will be recorded, so if there's anything you miss or want to review later down the road, we will have this up on our YouTube channel and up on our blog on earlygrowthfinancialservices.com. So without further ado, allow me to introduce Mr. Alaa Ismail. Alaa, good afternoon.
Good afternoon, Jason.
So let's talk a little bit about Early Growth Financial Services before we get started.
I'm happy to. Hello, everyone. Thanks for your time. A little bit about Early Growth before we get started. Early Growth is kind of a startup story in its own. Our founder, David Ehrenberg, started it in 2008, so we've been here for a little over 8 years, with a vision of providing financial services to early stage companies. And essentially what we do is split into several factors. We provide accounting and finance assistance to companies, and that involves essentially bookkeeping and the blocking and tackling of running the finances of a company. We also provide CFO consulting services for these companies. That could be anything as heavy as you want or as light as you need. We review financials. We set up the financial reporting packages. We assist you with projects or strategic finance initiatives that may come up from time to time, such as business modeling and forecasting. We assist in fundraising. The fundraising process is a kind of a critical phase in a lot of these in startup organizations. And we have a lot of experience because our CFOs have probably been through every single scenario that can be confronted out there. In addition to accounting and finance services, we also do taxes. So we will do your state and federal taxes, and we have a fairly robust and growing tax services department. In addition to that, we do valuation services, and we will get into the valuation in a little bit more depth as we go along, but we provide 409A valuations as well as other needed valuation services for you in your growth path. So in a nutshell, that's what Early Growth does. We have offices in San Francisco, Los Angeles, Seattle, Chicago, and in New York. I think, and Jason, you could correct me if I'm wrong, we're well over 500 clients at this point and growing.
Yeah, we deal roughly with about 1 in 5 of the venture-backed startups in the United States. So we've got some great coverage, and this is all a great segue into kind of an overarching presentation that this topic covers, which is the basics about setting the foundation for your startup, right? We're going to get you organized. We're going to make sure you're in compliance, which is extremely important, and get you ready to scale. So what we're going to be talking about today are the larger pieces, kind of overarching parts of your accounting and financial system that you should be cognizant of and aware of, especially as you're preparing for fundraising, as you're preparing to scale, and as you're beginning to, your business begins to coalesce from an idea or a basic product to an actual operation. So we're going to talk about accounting from both the pre and post funding perspectives and the systems in place as part of that. We're going to talk a little bit about taxes. We're going to talk about AP and AR. We're going to talk about financial projections and the type of financial reports that you need to know about and need to know how to put together. And then we're going to round out with valuation and then finish up the presentation with a short Q&A. So again, any question that you have either throughout or at the end of the presentation, you can use the questions panel that's within your GoToWebinar console. So we encourage you to ask any type of question along the way, along these topics and how it might pertain to your business specifically. So without further ado, we'll jump right into it with the pre-funding portion of accounting. So Alaa, why don't you talk to us a little bit about that?
Right. So in the pre-funding stage, that takes into consideration a lot of different sizes of companies, but we'll kind of go in the phase where you're just kind of been incorporated and maybe you haven't gotten any funding or have some small amounts of funding and you're in the development stage of your company. There's one kind of definition that I'd like to go through first because it comes up from time to time during the presentation, so it's good to kind of get that definition in order, and that's the accrual-based or cash-based accounting. In the early stages of a lot of companies, most folks are doing cash-based accounting, and very simply that means you recognize your revenue when you earn it or when you collect the cash, and you recognize your expense when you pay it. So it's a very, very simple process where your financials reflect really the cash balances or the cash transactions that are going through monthly, quarterly, or annual as your reporting structure will allow. Accrual basis is a little different, and accrual basis just simply says that you recognize revenue when you earn it and expenses when you incur it. So for example, if you had some services to one of your customers and you invoice them at the end of the month and they paid you a month later, accrual accounting says that you recognize that revenue in the month that you provided the services, not when you collected the cash. In the same way, the expenses are recognized when you incurred the expense, not when you paid for it. So that's just kind of an underlying definition I'd like to get to. But essentially, in the pre-funding stage, you want to keep things as simple as possible while still maintaining a little bit of structure. So the first thing you should do after you have your incorporation documents in order is open up a bank account. Ideally, that bank account is separate from your personal account, and expenses that are flowing through that bank account are unique to the business. One of the things that a lot of pre-funding companies or very early stage companies do is the bank account, opening up a new bank account is kind of tough, so we utilize whatever bank account we have, and all of a sudden a year later we have things like rent and mortgage payments alongside with real business expenses, and we have to go through and separate those. That is, requires a lot more work, and it's also may get companies in trouble if there's ever any kind of audit or anybody looking into your bank account. So we really recommend that you open up a business banking account and you separate your personal and business expenses from the get-go.
Although we've got a question that came in that we actually get fairly regularly, just in a variety of, but is there a particular kind of bank to choose? Will is the normal neighborhood bank a good choice, or are there startup-focused banks, that would be better tailored to working with a potential high-growth company? We know the answer to that because we deal with that every day, but could you talk a little bit about that as well?
That's an excellent question. Yes, as a matter of fact, a lot of the banks that you might think are ideal for startups, like a Wells Fargo, Bank of America, or Chase, may not be the best option for you just because they don't cater to early stage companies. Their primary business focus is either for the day-to-day depositors or the large corporations. One of the benefits in working with a company like Early Growth is that we are familiar with the ecosystems out there, so we could recommend banks to you that cater to the needs of early stage companies. especially in the early stages, you're going to need a lot more services from your bank. So these banks, for example, in California, we have Silicon Valley Bank, we have CNB, we have a lot of different banks, First Republic Bank. A lot of these banks cater to early stage companies. There's similar banks throughout the country that we are very familiar with and that you should interview prior to opening up the account, just to make sure that they cater to your early stage needs. So that's an excellent question, and the strong recommendation there is to go to these banks prior to going to kind of the conglomerate banks out there, the big five banks. Does that answer the question?
Yeah, absolutely. And as Alaa mentioned, that's something, if you ever have questions about what kind of bank is right for your particular situation, you can reach out to us as well. We're happy to discuss that with you. Just a conversation. It doesn't have to be anything engaging. But yeah, another great question. So thanks for answering that, Alaa.
No problem. The other thing is when you're in the pre-funding stage is keep records of your financial transactions, things like receipts and invoices. We will get to this in the accounts payable section of the presentation. Fortunately, there's so many tools out there that help you keep that in order. But in the early stages, let's be very, very mindful of that. A lot of times people's memories fade over the months, and that original documentation is critical to creating an accounting profile. So keep the records, receipts, invoices, business agreements, contracts, and so on, and make sure that you have that handy. Be mindful of your tax obligations. A lot of times companies get started. Say, for example, you start your company in June of a year, and there's really not a lot of transactions that happen. But the fact that you've been incorporated and you have no transactions, the IRS or the state does not know that. So they view you as a fully functioning company, and as such are required to file all the different tax returns that are required either in your locality and in for the IRS. So please take care of your tax obligations. Things like when you hire contractors, 1099s, if you pay payroll, paying your payroll taxes, all of those things are very, very important, even if they are infrequent transactions. So please keep in mind of that. In the early stages, collect your money. A lot of times companies are so excited to be in business and to have a customer that collections kind of goes by the wayside. It's kind of a grubby side of the business, but collect your money. That's a very, very important piece of advice. If you are going to have employees, it's really critical that you have somebody do the payroll for you. Fortunately, these days there are so many choices out there. There are basic choices that such as Gusto or Zen Payroll or Intuit has a very good payroll service that are so easy to sign up on and to get rolling that really there's not a lot of complexity. The big complexity comes in the payroll tax, and there's so many penalties and exposure related to, first of all, collecting payroll taxes from your employees and then remitting them to the appropriate to either the state or the federal government. So don't ever do payroll yourself. That is a big piece of advice. The cost is nominal, and there are so many choices out there, and the exposure is great. So please select a good payroll provider. Again, this is something that we could give you advice to because we essentially work with almost all of them. Lastly is stay on top of your stock records. As an early stage company, a lot of times cash is tight, and transactions with either contractors or employees are promised stock. Um, if you're going to put in a stock option plan, make sure that you get that documented well and have a lawyer draft that document properly. If you promise somebody stock, make sure that you paper that up. And if it's a contractor, there's appropriate documents that you need to complete. And make sure that that's all documented and that you're keeping a good capitalization table as you go along. Another error that I see a lot of early stage companies is as you're going along, you hire an engineer and you say, I'll pay you X in cash and this much in stock, and the transaction is forgotten. And now you're in the middle of a round or a seed round of financing. And then all of these items start coming up and you're scrambling to try to put all that together. It's really, really important as you're going along. If you're promising somebody stock, that you're in consultation with your lawyer and that you are going under a qualified stock option plan if you're in that era, if you're in that stage of your company, and that all of those transactions are recorded properly and that you're on top of it. That's an often missed area in early stage companies, especially in the pre-funding side.
Right, and we're going to make the jump here in the next slide to post-funding, but it's very important to know that when you're approaching investors that
Okay, in the post-funding, Jason, are you hearing me?
Yes, can you hear me okay?
Yes, I'm sorry, I lost you for a bit there. So when you finally have some funding, and funding doesn't need to be a formal large round. A lot of times funding could be as simple as a small convertible debt or a friends and family raise. But once you start having other people's money involved, your risks and your requirements grow. So, so you need to also at that stage get a better understanding of your business, and that is usually it revolves around creating a good accounting system. So the first thing I recommend as a foundation for a company is to put in one of the accounting systems out there. The one that we use is QuickBooks. QuickBooks has become easier and easier with the QuickBooks Online offering. It is a very simple tool that anybody can use, even if you don't have any accounting or finance background. And it integrates with so many different, with banks. It integrates with accounts payable, cloud-based accounts payable companies, with payroll. So it's a very, very robust, very open system that could really be the foundation of your accounting system. It also grows. So as the complexity of your company grows, QuickBooks can grow along with you, and those records are available to you during that growth path. So creating an accounting system like QuickBooks is really, really important. While I'm talking about that, there are other companies out there that are getting into the space. One that comes to mind is called Xero with an X. And Xero is a really, really nice looking system. It's super easy to get started with. The issues that I would bring up with that is that when selecting an accountant or a bookkeeper or somebody to help you with that system, there are fewer people that are familiar with it. So startup time is a little bit more. The other issue with it is it's not transferable. So at some point, if you want all that accounting data to be transferred to a bigger system once you're a bigger company, all that history is essentially lost. You can't transfer all the detail accounts payable transaction, the detail payments, banking transactions, all that is lost. So keep that in mind if you ever want to select that system. Then build that financial infrastructure. We'll be talking about accounts payable and accounts receivable. We'll be talking about payroll. But At this stage, you want to be able to be in a situation that your accounting and finance is essentially all set up. And I really, one analogy that I use for companies in this stage, it's a lot like dentistry. If you go from your pre-funding to your funding stage thinking that, I could use the same structure and the same thing that I've been doing all along, my bills are getting paid, my people are getting paid, why do I need to change? Well, a lot like dentistry is like if your teeth are feeling fine, the issues come up when you start having a problem. And when problems arise with your teeth, it's usually painful and expensive. It's the exact same thing with accounting. If you don't set up a proper system from the very, very beginning and are not diligent in maintaining it, at some stage you're going to run into trouble. And keeping that maintenance from the get-go is very, very important. At this stage, you also basically have a better understanding of where your growth is going to take you. So it's really helpful to figure out what your funding objectives are. Some companies may not need outside money. It could be that you have had so much traction in your business that you could self-fund, or you could maybe obtain some bank funding. The other options could be small convertible debt from various sources. It could then be another funding source could be seed investor, somebody who's very familiar with your business, who knows you, who joins you in your vision and could be an individual seed investor. Or then it goes into the institutional, whether it's venture-backed or other funding sources. This is the time to figure out where your objectives are, so you could align your business goals with these objectives. In the early stages, when you have some funding, it's really, really important to manage your cash flow. Along with that comes with having a really good forecast. We'll go into the detail of that further in the presentation, but a good cash flow and a business forecast is a roadmap that needs to be followed and is a very, very important tool. When you are having some funding from either institutional investors or individual investors, they're going to want to see the progress that you're making. So getting clean financials put in a format that your investors could understand is really important at this stage of your company. And the one thing that I advise all entrepreneurs in the very early stage is get help. Don't try to do everything yourself. A lot of entrepreneurs are very, very smart and believe that they can do all aspects of their business. But especially in the financial side, help is available out there. So get folks that could help you in your strategic planning, your fundraising, your forecasting, and then your blocking and tackling, your day-to-day financial needs. And that's where companies like Early Growth really come in and are a great solution in early stage.
Great, thanks, Alaa. That actually ends up being a great segue into talking a little bit about finance and accounting support and what type of, what kind of criteria you should be looking at when it becomes time to sit down and speak with a financial services firm.
So if you've raised any kind of money from an outside source, a convertible note or a seed round of financing, convertible notes are probably the most common form of very early stage financing. That is the reason why that convertible notes are so preferred is that in early stages, companies' valuation is very difficult. Just because their company hasn't gotten a lot of tractions, there may not be a lot of comparables out there. There needs to be some kind of an event to help other investors come in and really fund and really price the round. So convertible notes are typically structured in a way that they convert based on certain milestones in the agreement. And they convert at a discount anywhere between 10 to as high as 30%. And they accrue interest. So for an early stage individual investor or a few individual investors, it's a really good way to fund the company and not have to worry about valuation. So if you're in that stage, you're going to have reporting requirements, and I think that's when you should start looking for outside support. Anything from an institutional investor, you'll probably be required to do regular reporting, whether it's monthly or quarterly. That's a good time to get finance and accounting support. Or if you have revenue, if you're generating revenue and you have complexity in transactions, whether you have an investor or not, that's a really important time to have finance help or accounting help. Institutional investors, like I said before, will require you to have financial reporting. Most venture capital companies require at least quarterly reporting, and they have certain guidelines, and those guidelines are around accrual-based and GAAP accounting. So having somebody that understands that complexity and can present it in a proper way is really important. Finally, I think that one of the biggest kind of intangibles of having a good finance and accounting help is it adds to your credibility. By presenting something that looks professional and is something that is familiar with your investors and with the outside world, just lends a great deal of credibility to you as a company. And that's very, very helpful as you grow.
Great. So it's time to get down into the nitty-gritty a little bit on the accounting side. So we'll start by talking about AP or accounts payable. So Alaa, can you talk to us a little bit about that?
Right, yeah. In the old days, accounts payable was a real pain. It required, files and files for each vendor, and because it was so difficult, a lot of people didn't do it very well. But as you know, in your personal finances, keeping track of your bills and expenses that you have to pay is important. It's the same thing for businesses. The nice thing is that there's been so many tools have been created right now for companies to set up their accounts payable. So there's a company that we use called Bill.com. It's essentially an automated bill pay service. It's really cool because it allows all your vendors to set up a cloud to send you invoices electronically. Bill.com links to almost every single accounting system out there, including QuickBooks. It allows you to pay your vendors through the same interface. And it gives you a cloud-based accounts payable file, so you're keeping track of all your invoices. Remember when we initially talked that when your pre-funding stage is keeping tracks of accounting records? A company like Bill.com or a structure like Bill.com automates everything for you. And as you grow, that is so helpful because you now have a cloud-based system with all of your records on it, so you're able to go into any kind of due diligence and feel very confident that you have a complete coverage. So setting that up is critical. The other reason why something like a Bill.com is important, if you're doing what we're asking you to do and you're getting outside accounting help, Bill.com allows you to have levels of approval. So you still control your cash. So somebody could set up your payables, could set up all your expenses, and then get them ready for payment. And then another individual, whether it's you as the entrepreneur or somebody in your organization that you trust with that approval, finalizes the transaction and gets the items paid. So Bill.com is a great way to set up a system very early, very easy, very cheap, and gives you all the reports, and it integrates to QuickBooks, Xero, and all the other accounting systems. The other item that the other tool that I recommend for early stage companies is for expenses. As you know, in the early stages, a lot of employees or partners will be incurring expenses for the company and collecting receipts and bills and so on. So not only do you have to collect all that data, but you also have to reimburse folks. There's another tool that we use called Expensify. There's several of them out there, but we like Expensify. It's very, very simple to use. It's super cool. It allows you to, you know, take pictures of your receipts and really, really track your expenses. We utilize it for companies even in later stages by formalizing their expense policies. So once you get bigger, you could, your employees, when they go there and they charge a meal, for example, the Expensify will say, wait a minute, our policy is $60 for lunch and you spend $70, and it flags all of these items. So Expensify is a really, really good tool for tracking expenses and receipts, as well as Bill.com. Once you have a tool like that, you are able then to integrate with an accounting system like QuickBooks or like Xero, and therefore you could establish an accounts payable schedule. Early stage companies, cash is always king, and knowing what you owe and when it's owed is really, really important, because you need to build your reputation as a company, and that reputation involves paying bills on time, and also manage your cash flow. So that requires managing all that. So having a good AP schedule and an AP system is critical. As best as you can, and I know it's difficult a lot of times for early stage companies because they don't have a lot of credit history, it's really important to start getting terms with your vendors. It's easy to pay things on credit cards and be current on everything, but it's important for you to start establishing terms. It's kind of a simple way to extend your cash flow and to build credit history. So as you're in the later stages, as you're negotiating with vendors, try as best you can to establish payment terms.
Great. So let's flip it over to the other side and talk accounts receivable.
Accounts receivable, very important. So another kind of story here. Some of my clients, especially when they're pre-revenue, are so eager to get into the revenue phase that accounts receivable is kind of a grubby little sideline of the excitement that is builds when somebody is in revenue. So an example, I have a recent client that their first transaction was with a company, and they started doing work without any agreements, and they went about 4 or 5 months without ever collecting on any of their invoices. And then finally, when they went out to collect, they found out that the company had no intention of paying, that the company was didn't have any financial wherewithal to pay. And one of the things that a lot of first stage entrepreneurs realize, that collecting in a business environment is a lot more difficult than it seems. Companies don't have the pressure of credit agencies going after them. They are not as they're not as aware of credit ratings. So getting a really, really good handle on your accounts receivable helps you avoid issues like this. And in this case, a company was a significant amount of cash that they had to write off, and a significant amount of time for their employees that helped service that client for about a 4-month time that they were not able to recoup. So as you're building up your accounts receivable system and integrating it to your accounting system, you'll be able to get an open invoice listing and an aging. Bill.com can help you with that. We also have other sources that can help with the invoicing process. But reviewing that on a timely basis will help you identify payment issues and help you react to problems when they occur. creating an agreement or an invoice with your customers that's easy to read, that's consistent with your negotiated um, business contract. Whether it's early stage, whether it's friendly, it's always important to get things on paper. So your terms and conditions should either be clearly spelled out in your invoices or clearly spelled out in the contract that you have with your customer. Along with the terms, it's important, along with all the contractual obligations to your business, you need to also be very, very clear to put payment terms on there. Don't be afraid to ask for early payment terms. Not every single company gets net 30. And a lot of your customers will understand, especially in the early stages of your company, that if you ask for 15 payment terms or on receipt payment terms, but make sure you talk about that early on, because sometimes you'll be surprised that companies have 60, 90-day payment terms. And if you're counting on getting your money earlier, it's important that you understand these things first before getting into the transaction. So getting your payment terms in writing kind of helps bring that up and gets you to talk about it prior to the transaction taking place. When you're in business and you need to know who your customers are, establish good credit guidelines. Don't be so excited about getting into a revenue transaction that you forget who you're in business with. If you're working with companies that are foreign-based, it might be more difficult to get paid by them. So really, really look at your credit guidelines prior to getting into a business transaction. And don't be afraid to be tough with your client and tell them, like, you know, we don't have a lot of history with you. Let's establish credit terms over the first 6 months, and then we could revisit it later. And then figure out a collection timeline. At what point do you need to go to your customers and start demanding payment? And at what point will you have to do difficult things like turn off services or stop working? But having those guidelines in place early on really helps you manage your cash. And that's really, really important in early stage post-funding companies.
Great. So let's talk a little bit about everyone's favorite topic, which is taxes. And you touched on it a little earlier, but I feel like it's important to say it out loud again, that even if you're incorporated but you're pre-revenue, you could still have tax obligations. So just because you're pre-revenue doesn't mean you should shrug off your looking at taxes at the end of the year, because that can end up getting you in a little bit of hot water.
Right, absolutely. I mean, that's a very important point, Jason. You know, the one thing we kind of touched on briefly is the incorporation side. So when you first get into business, you'll probably have to choose what kind of corporate structure you'll be working under. It could be an LLC, a limited liability corporation. It could be a sub-S corporation. It could be a C Corp. You need to know what municipality, where you're incorporated. Are you a Delaware corporation? Are you a New York corporation? Are you a California corporation? Based on that criteria, you're going to have different tax reporting requirements. You're going to have federal, state, and you're going to have city and local taxes that are due. For example, here in San Francisco, and I know in New York, there's local taxes. New York City has taxes. San Francisco has a tax base, so you have to understand those taxes. Those taxes are not dependent on revenue. So even if you're have no revenue at all and significant losses, you still have tax obligations in a lot of cities. Some states have franchise filing fees that are independent of whether you're in a profit situation or not. And so you still have to pay those taxes. And in every single case, whether you have tax obligations or not, they require tax filing. You have to send in some kind of document. So, and you have to be timely. a lot of times companies, just because they don't have any earnings or any profits, they let that go aside and they're surprised to see the related penalties associated with them. So it's important to understand that, what those obligations are. And that here, a tax professional could be probably your biggest lifesaver, or a company like Early Growth, where we understand all the different filing and tax requirements, and we can help you keep current and save a lot of money. There's also we talked about separating your business and personal finances. From a tax perspective, it's important to understand, that there's certain things that you could deduct from a business side that are not deductible from your personal. So separating the personal and business items for tax is going to be really, really critical, and could be a big exposure if you were to ever get audited. And then finally is if you're in a profit situation, you might have quarterly tax obligations. Just because the filing is due at the end of the year, that doesn't mean the government wants their money earlier. So you may have quarterly tax payment obligations as well. So getting appropriate tax advice is really critical, so you could avoid penalties and interest and so on. Finally is two areas that I'd like to cover: sales tax and payroll taxes, and related to that, nines. Payroll taxes are a financial obligation of officers and directors of companies. If you do not hire a proper payroll provider that collects the taxes and remits them for you on a timely basis, you as officers and directors are not just liable, but you're personally liable for that, because the governments look at it that you've essentially taken somebody else's money and you didn't pay it for them. So staying on top of payroll taxes, making sure that they're deducted properly and that they're paid properly and timely, is a very, very big exposure as an officer or director of a company that you should make sure is that you're staying on top of. Also, in early stages, companies hire a lot of contractors. And when you hire a contractor, you have an obligation to submit 1099s for those vendors that qualify to get 1099s. It's essentially a way for the government for the tax authorities to know who to tax and how much to tax. So 1099s are due annually at the end of January. You need to send them out to your contractors. There's a way that helps you figure out who gets 1099s and doesn't. There's a form called W-9 form that should be sent to all your vendors. Again, this is something that we help with at Early Growth, but it's a very important item, and it could lead to a lot of taxes and penalties that you should stay on top of. And finally, sales taxes, especially in New York and Colorado and in Texas. SaaS companies' services are taxable. So knowing what is sales tax that has sales tax exposure and what does not is really, really important. So I have a client here in California that has an employee in New York, and it's a SaaS company, and has several clients in New York, and they just got audited by the New York authorities. And they said, wait a minute, we don't have an office in New York. We don't have to charge taxes. Well, having an employee in New York qualified them to collect sales taxes on behalf of the state of New York. And they unfortunately had to pay quite a bit of taxes, sales taxes, and related interest and penalties. So staying on top of that is also important. So knowing when and how sales tax applies is something that you should be aware of.
Now we've got a question that came in. It may actually be a great follow-up for our tax gurus on the tax team, but are there any additional tax considerations for foreign companies starting a U.S. subsidiary for the first time? You know of any instances just off the top of your head where there would be, a specific and additional tax obligations for that type of entity?
There's no additional tax obligations for a company, a foreign-owned company. There are reporting requirements if certain percentages of the company are owned by foreign nationals, and that would be addressed in your tax filing. So, for example, if you're a company that has 100% ownership by an individual or a company that's a foreign entity, that has to be disclosed in your tax returns. There are, however, if in companies that have foreign subsidiary or parent relationships, there are transfer pricing issues that that need to be considered on both sides. If we're talking about Europe, I know every single country in Europe has that, and I know in the United States we have that as well. So the interactions between the two entities, the foreign and the U.S., there's a lot of different tax complexity that goes around that, especially with the transactions between the parent and the sub that need to be considered. And if you're ever in that kind of situation, it's really, really important to hire a tax person that's familiar with transfer tax issues and foreign ownership issues as well. But to address your question directly, there are no, to my understanding, there are no restrictions for a foreign entity to own a U.S. corporation as long as you file the appropriate incorporation documents.
Great, and for you listeners who might fit in that situation, being a foreign company looking to start operations in the U.S., I'll take a moment to plug our blog. We do have a great primer on transfer pricing and how that might affect you opening operations in the U.S. So you can easily search that on our blog by just dropping in the phrase transfer pricing in the search bar. So that's something worth checking out for a little bit more information on that side of things. It was written by our Chief Tax Officer, Anjum Tanuli, who is our guru, all things considered. So great, we're going to shift gears a little bit and move over and talk a little bit about financial projections.
Yeah, very, very important tool, in my opinion. In the pre-funding stages, I think financial projections are important because it gives you a roadmap of how you're going to utilize your resources. And it also helps you kind of put numbers behind your operating goals. So there's two types of projections that are out there. There's a top-down projection. A top-down projection is very high level. You typically start with say a market size. So, if you're selling sushi to the San Francisco area, then you say, okay, the total market size of the sushi market in San Francisco is X, and we're going to probably capture Y. So a lot of companies in their top-down projections start with their revenue forecast. And then based on that, you identify the different expenses that are associated in generating that revenue. So if you're selling a product, there might be a product cost or gross margin considerations that you might want to take place. In a top-down projection, it's simply a percentage. So, for every $100 of revenue, I'm going to incur $20 of expenses. So my gross margin is 80%. And then from that, we extrapolate certain operating expenses, again, on a percentage basis. I'm going to have X in marketing, Y in sales. It's not very detailed. It's essentially a projection based on percentages. And a lot of times it kind of helps frame things and gives you a kind of an overview of how your forecast will look. Top-down projections are great for long-term pictures. If you want to do a top-down, for 2 or 3 years, that's a really, really good method of financial projections. For more detail and for more operational projections, I really recommend a bottom-up projection. The difference between, say, a bottom-up and a top-down on the revenue side will be in the detail. For example, you'll say, okay, here's my pipeline. Here are the customers that I'm going to address. Each customer, the revenue for each one of these customers is stated. The likelihood of you closing that customer is stated. So you have more detail behind the revenue. The expense items are captured in detail. So instead of saying my headcount is X% of revenue, you're going to say I'm going to hire 3 marketing folks, 2 salespeople, 6 engineers, and here is the salaries for each. So the detail for that, the spending is a lot more tied to the operational goals of the company. And that bottom-up projection then is expanded based on that detail. So if you want to go into it 1, 2, or 3 years, you then take that 1-year bottom-up projection and then you expand it to the 2nd or 3rd year. For a lot of my clients, I recommend in their forecast to have the 1st year of operation to be bottom-up, just because it's something that is probably that you're probably doing already. You know who you're going to hire. You have an idea of what your market is and who your customers may be. So a bottom-up projection is very, very detailed. Also, the execution is a lot more critical. So having a top-down forecast for in 1 year may not be the best operational tool for you. Bottom-up for 1 year is very, very important. And then after that, you could then do top-down projections. For example, you could take your bottom-up revenue projection for 2016 and do some kind of assumption for growth, 20%, 30%, 100% growth, and then take your operating expense percentages and just extrapolate those forward. So your financial projections could be kind of a hybrid. For 1 year, be bottom-up, and for outgoing years, be top-down. My final thing about financial projections is that projections are really a roadmap. It should be a tool for you to use to help steer where you're going. And as such, it should be updated regularly. If you're a nimble early stage company, things are changing. So your forecast should change along with your business. So this is something that you should look at quarterly at least and update it as you go along, and keep looking at it and to help you guide your business decisions. Because if you don't know where you're going, you really don't know how the deliverables or what to do to execute on that vision. And a good financial bottom-up forecast will really be helpful.
All right, so let's get into, it's only one slide, but there's a lot of important information here, and that's your financial statements and the financial reporting that comes from those statements. So let's just jump right in with the big 3 there, the P&L, the cash flow statement, and the balance sheet.
Right. So whenever you present your financials to the outside world, this is the financials package that they will expect. A profit and loss is, I'm sure all of you are familiar with it. It's essentially a listing of your revenue, and it reduces all your expenses to give you a profit or a loss depending on your condition. It's essentially an income statement for the period, and typically profit and loss and financial statements are generated on a monthly basis. A balance sheet is a listing of your assets and related liabilities. So a balance sheet will give you our snapshot in time, and typically they are monthly as well, but they take a picture of your assets, liabilities, and equity at a certain point of time. So things like cash, accounts receivable, prepaid expenses, capital assets, fixed assets like office machinery and equipment. your accounts payable, your debt, any related liabilities will be listed on the balance sheet. And of course, the equity structure of your company will also be listed on your balance sheet. Cash flow statement is used when you're using accrual-based accounting, and it essentially reconciles your accrual income or loss to your cash balance. As you, there's certain things that in an accrual account, profit and loss statement that may not be directly tied to cash. So for example, if you had $100,000 of sales in 1 month, but all of that sales went through accounts receivable, you may have earned that revenue, but you may not have collected it. So a cash flow statement reconciles all of the cash items from your accrual-based income statement to reconcile down to your ending balance. Of course, a cash flow statement is really, really critical because it helps you understand where your cash went, and it helps you understand differences between your accrual-based income statement and what you actually have in the bank. It also helps outside investors understand your burn rates. I'm sure that's a term that all of you have heard. And the cash flow statement highlights that, your monthly burn, how much money you go through on a monthly, quarterly, annual basis. Cash burn reporting comes from that cash flow statement, and a lot of times, you know, folks in the investment world not only want to know your accrual-based profit and loss, but they want to know how you're utilizing that cash. So for example, there's things that are not reflected on your income statement, things like capital expenditures, like if you're buying a lot of equipment or in a new facility and you're building up that facility, you may have spent a lot of cash on it, but it's not directly showing up on your income statement because you're amortizing it over a period of time. So that cash burn reporting usually stems from the cash flow statement. If you create a forecast, then a report that tells folks how you did against that forecast may be required. So you essentially have to align your budgets or your forecast that we talked about in the previous slide with your financial reporting structure. And when I engage with a lot of my clients, I try to tie their financial reporting directly to their forecast, so they're the exact same model. As you generate actual financials, it plugs in directly into your forecast, and then you're able to show whoever is interested, whether it's internally in a management team or externally with an investment folks, how you're tracking against your forecast. It helps identify operational efficiencies or operational issues. And finally, there's other non-financial non-financial statement reporting requirements. An example of that would be SaaS companies, software as a service companies. They have a lot of metrics that are sometimes very key to figuring out the operations of a company, things like ARR, annual recurring revenue, or MRR, monthly recurring revenue. In enterprise software companies, booking reports are very, very important. So there's a lot of other pipeline for a sales forecast is another non-financial statement but financial reporting requirement that you, as a CFO, we usually help our clients in generating and may be required from the outside world.
All right, so let's wrap up the discussion here on a couple slides about business valuations and kind of jump into, you know, what it is and why they're required.
Okay. A while ago, there was an issue with stock option pricing where there was a lot of companies taking advantage of stock options and trying to attract employees by backdating stock option pricing. So for example, the fair market value of your company may require $1 a share for your option pricing, but to attract a certain employee, you might price it at 50 cents or 25 cents a share. So the IRS became aware of that a while ago, and in an effort to rein in that process, they came up with a new IRS code called, appropriately, 409A. And it essentially requires companies with a stock option plan to have regular valuations from an outside source to determine the fair market value of those stock options. And it's essentially taking that pricing away from the board of directors or the company, and saying that you have to have a credible outside source figure that number out. The general guidelines around it is that it needs to be done annually, or whenever there's a material change in the company. So, for example, if within the year you go through 2 financing rounds, you may need to have 2 valuations done. Or during the year, one of your biggest competitors gets acquired for, $10 billion. And that's a material effect on your valuation. You may need to get a valuation. So the IRS requirement gives you at least 12 months worth of cover. But as a board of directors or as a management team, you also need to be aware of significant events that may affect the valuation of your company. And if that happens, you need to get a 409A valuation done. Now, this has become a very regular part of doing business now, and with a lot of companies with qualified stock option plans. So it's also become a very big part of what services we offer to our clients. So typically, you want to select a credible 409A valuation company that could get you the reports on a timely basis. The reason why a fast turnaround is important: you go through a financing round and you have all this money in the bank, and now you're hiring folks. Those folks want to get stock options, and they want to know what the pricing is. So you don't want to wait months and months to get your 409A valuation done. Because 409A valuations have become a commodity, like anything, there's a lot of low-cost service providers out there, and they outsource that service to other countries, and as a result, the quality of the work and the timing of the work is usually suspect. A lot of companies will lure you in with low initial pricing, but as you go through the process, you'll require that you need iterations of the report, and with every iteration, then there's a cost. So make sure that when you get quoted for the 409A valuation report, that there's no revision pricing and so on. Make sure that the firm that you're using with is familiar with the requirements from the IRS and with potential acquirers or Big Four accounting firms. The reason why the 409A requirement is there is that essentially you want to cover your butt. And the way to cover that is to make sure that you have a credible company and that has done your 409A valuation that could withstand any kind of scrutiny, either from the IRS or the state or any potential acquirer. The other part is that 409A valuations have become kind of a recruiting issue. You want to make sure that the 409A company is not overvaluing your stock options, because you want to be able to attract employees, and having an inflated option price may restrict your ability to attract those key employees. So you want to be able to work with that company within their guidelines to get the best possible valuation that you can. And then the same company, because they're doing your 409A valuation work, they're going to be very, very familiar with your business. So there may be some other valuation work that will be needed at later stages. So getting with a good company with a good track record that could offer these other services will be a significant time savings and a very, very efficient thing for you to have. Um, so those are kind of the overview of what to look for when you're getting a good valuation company, and that having a good valuation company comes with a really big caveat is that you're maintaining great capitalization table. Like we mentioned early on, getting a hold of your stock options and your equity structure in a good capitalization table that is current is very, very key.
Now, we had a question come in and maybe more tinged toward the fundraising side of things, but um, when it comes time to talking 409A valuations, do VC term sheets have any kind of play in this, either in the initial valuation or down the road, or is that more of a separate kind of fundraising discussion?
So when a company does, when you hire a 409A valuation company, one of the key documents they're going to request is any kind of offering term sheets that you might have just signed. So say, for example, you've just completed a financing round. Those terms are going to be of that financing round are going to be critical in the valuation of the company, and a good valuation company will take that into consideration. Things like preferences, of course, preferred stock pricing is part of what they look at in determining their ultimate valuation.
Gotcha. Okay, great. Well, we've moved on to the end here with the Q&A. We've hit most of the questions that we received along the way here, and we are unfortunately over our normal 60-minute runtime. So I think we're going to wrap it up here, and we've got our contact information here on the last slide. So if you've got a question that didn't get answered today, or one that crops up, in the coming days, you can shoot us an email at the address there. You can reach out to us a couple different ways, actually. Twitter users, phone calls the way to go. Please reach out to us. We're happy to engage with you directly and help get your questions answered. And the recording of this webinar will be up on our YouTube page, usually within 24 hours. You'll also, as a registrant to this webinar, receive an email within 24 hours with a link to view this video. So a couple different ways to get your hands on it if you need to do any review. So Alaa, I appreciate your time today. Thank you for joining us and imparting some of your infinite wisdom. And thanks again to everybody that attended today, and hope to see you next time.